Good morning, good afternoon, good evening. Today I will speak about a bit further intermediate level about the Forex trading analysis. And I will speak mainly about the technical analysis in this video. Of course, I am coming huge videos on fundamental analysis and technical analysis. So I will speak today about the a bit little discussing about the psychology of the forex trading. The psychology is how big your account, how much you want to invest in capital, or how much your money you start forex trading. I'm talking about the all individual traders, and some are even the day traders, or some are doing a part-time trading. They may be doing the jobs and part-time extra time using to trade in forex. So I will speak about some of the psychology that how much money you want to invest and how much you take the risk. In forex analysis gurus, they are saying that maximum you take a risk of your capital, total capital, 2%. 2%. So it is very important that you take a trade or you take a risk and maximum 2%. That is important. Some people, they put all the money and take even 10, 20, 30, 40, 50, 100% risks. So it is dangerous that has to do a forex trading in risk management. That is very important about the risk management in forex. Again, I am saying that trading risk management is important. And secondly, especially I am talking about the day trader. What happened day trader sometimes? So in the early of the day or the starting of the trade, they lost money. And to recover that money, they started trade. Loss again trade, loss again trade, loss again trade, loss again trade, loss against trade, loss again trade. And this is like a gambling. Trading is not gambling. When you lose a trade or you think you're losing a trade, then as soon as get out of the trade is important. You cannot do again in a situation or same time that again to recover your money, and that is happening. So this psychology is very important, that if you lose the money in a day trading in the day early, so you think about why you lost, and not to go in a crazy situation or in a gambling situation. So I'm talking about that is important, the psychology. Now about the all the chart and all the news, CNBC, Bloomberg, FTC, or stock, or the Forex, the market, all the informations, one must know, and know means updated. And about the technical, about the charts, or about the candles, or about the MACD, or about the RSI, or about the channels, everything must be precise. A brain surgeon just not one day be a brain surgeon, studying hard years and years and years, and then the practice under a specialist, and then a brain surgeon. Same as a barrister, years and years studying, and then practice in the court under a senior barrister, or same as a chartered accountant. Is not overnight to making a balance sheet or making a statement or cash flow and forecast a company. It has to be a practice, 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 learning, learning, learn. Now, about the candles, already I have spoken that the behavior of the candles different of the candles, their sizes even, or their the candle's name or position has to precise or precision is like a measurement in centimeter, millimeter by millimeter. And think about, and then you do bull or bear, buy or sell. So it's not just like putting, which do the scalping trader. They just scalp. And fishing. So ultimately, 10 lose or close, 10 lose, close, 10 lose, close. So the company or the broker company, they benefited of this all the trade commissions. Now about the indicator. How many indicators? There are many indicators like stochastic or the MACD or the volatile ratio or the money flow index or the center of gravity or the mm, random wall or the ADX or the ATR or the moving average, about the moving average, how many days moving average, 14 days normally they do, and then the double smooth stochastic and the price volume rank, and the Gopag or center of gravity. There are many indicators, and someone has to learn about the movement of the indicator, how the movement of the indicator work. And this, why this the indicator is going diversification, this is volatility, and volatility is depends on the liquidity. Volatility depends on the liquidity, and moving average, 20 days moving average, 50 days moving average, 200 days moving average. This is very important. And that speed of change is momentum. Momentum, volatility, and liquidity. And this is the market precedence. Then, many years before, I met Mr. Bollinger in London. He is one of the master or the creator of Bollinger Band. He lives in America, New York, and he came to London and I met him. He has a book, Bollinger Band. So, Bollinger Band also very important, that this has to find out that what is this situation. And then, of course, there is a definition from school days. A moving average is the average of consecutive data points. In this way, fluctuations in a curve are reduced and overall trend can become apparent. And thus, it really, at least as far as simple moving averages are concerned, technical analysis, a 10-day simple moving average is the 10-day sum of prices divided by 10. Old data is dropped as new data becomes available. So, moving data is 10 days closing trade divided by 10, and what is found, that is a 10 days moving average. A 10 days simple moving average, a 10 day simple moving average is the 10-day sum of usually closing of the trade prices divided by 10. So, this is called 10-day moving average. Moving average are a trend smoothing device by nature that take price action and confirm a trend once underway. Buy and sell signals are offered but may be late. Moving average are not helpful when a market is range trading. They are very useful for system trading. No need for interpretation as with patterns. Arguably, moving average should be placed to trade by half time span. That would be a statistical approach. So, moving average is three main types. Simple moving average, only the period in question covered in the calculation and each data point given equal weight. Weighted moving average to the front in 10-day average, 10-day time 10, 9-day, 9 etc. and total divided by sum of multipliers. Exponential moving average weighted to the front of all data for life of instrument are included. S&P 200, S&P 500 data 50-day moving average data points used. Normally closing prices for the midpoint of their range would also make sense. Moving average. So how many type of moving average? Three type of moving average. Simple moving average, weighted moving average, and exponential moving average. So this is the things, and moving average length. Different periods are traditionally used different securities. 50 divided by 200 day combination in common in equity markets, although something like 63 divided by 252 day might well be more logical. So normally moving average 10 days, 20 days and 50 days. And shorter is 5 days, 10 days and 20 days. And more shorter 4 days, 9 days and 18 days. The shorter the time period, the more sensitive the average. Signals, price crossover. Simple signals can capture uptrends and downtrends. But moving average is not good for sideways. So this is the moving average, these things. And moving crossover and double and triple crossover method. Some people, they do 9 days and 16-day moving average. Now about the most important is what is golden cross or dead cross. Golden cross, bullish moving average crossover, but the slow moving average should already be starting to the rise when the fast faster process from below to above. Dread cross, bearish moving average crossover, but the slow moving average should already be starting to decline when the faster crosses from above to below. So there is a two types of crossover. One we call golden crossover moving average, another called dead crossover. And this is very important. We know this moving average crossover and dead crossover. Now compare moving average crossover signals and find out how this works. Is it too fast, too soon, is not sustainable? So there is a parabolic trend and unsustainable. So it is very important that the moving average, how this works, how this moving average 10 days, 20 days and 50 days average is working. Is it overbought or oversold? So these things we can find out with the moving average, RSI and stochastic. Anyway, I will speak about the more about this video about the RSI and stochastic. Hopefully, this moving average I try to explain, but it is still simple that you try to have 10 days, 20 days and 50 days moving average and see what is the situation of the moving average line. And thank you, speak next video.